Welcome to today's web lesson. This is part 2 of Market Health. We're going to be looking at my weekend routine. I've had a lot of questions from various people about how I track market health, and I have a daily routine which I already posted, and this is my weekend routine. I'm actually in the process of changing some of this data, trying to automate more of it. It can be a little labor intensive at times, but like anything, the more you do it, the quicker you get at it. The first page in my workbook, I'm mostly looking at monetary indicators. If you'd like to learn more about this, you can read Marty Zweig's book, Winning on Wall Street. I got a lot of these ideas in regards to monitoring monetary indicators from him, and it's a good book, definitely worth reading. The first column, we're looking at the prime rate indicator as issued by the Fed, and you can see that over the years the interest rate has gone up and it's also gone down. Usually when it goes up, it tends to be bad for stocks, and when it goes down, it tends to be good for stocks. Whenever the Fed raises it by 1% or more, that's usually a bad sign for stocks, or if it has a series of raises that add up to about 0.5 to 1%, I might start to get cautious about the market. Whenever they cut the rate by about 1%, you can expect the stock market will usually react favorably. You can see how I have buy neutral information on how I'm interpreting the prime rate. We also have the primary discount rate, which I just keep an eye on. The discount rate is the charge of interest that is applied to commercial banks and other institutions on loans that they receive from the Federal Reserve, and that can positively or adversely affect their lending practices and how well they're doing, which can directly affect the economy. And just in case there are those who don't know what the first category was, the prime rate indicator, that's the interest rate that commercial banks charge most of its customers. That would be you and me when we go for loans for houses and cars and things like that. The more interest they charge, the less money we as consumers have to spend on things. The federal fund interest rate is what the Federal Reserve will pay institutions who are leaving their depository overnight. They get a little interest for using the Federal Reserve. And this final column here, it's the Federal Reserve requirements. They refers to the amount of funds that a bank must have on hand each night. The bank can hold it either in cash in its vault or as a deposit at the local Federal Reserve Bank. Often, the more money that they are required to have means the less money they're able to lend out. But they use it to try to keep the institution solvent in case of emergencies. The installment debt indicator is just debt that's paid on monthly installments, some kind of regular payment plan. And the size of those debts are of course affected by interest rates that are charged. In general, it's consumer debt that is taken on by people that's not secured by real estate. It's comprised of revolving debt, that would include credit cards issued by banks or retail stores, gasoline companies. And the rest is non-revolving, and that would consist of like outright loans to purchase automobiles, boats, mobile homes, home improvement, education, and things like that. The idea is that when households feel more secure about their jobs and their incomes, then they often become much more comfortable in taking on new debt. On the other hand, if the economic climate is bad, like it was in 2008, 2009, people tend to be a lot more cautious about borrowing. Also, like I mentioned previously, the availability of funds to lend by the bank might also decrease during hard times as the Federal Reserve raises requirements, or if interest rates are high, that affects everything as well. So this gives me a quick, broad overview of the economic conditions, and it can give me a rough sense of what kind of shape we're in at a glance. The next thing I look at is the value line index. I collect data on it. You see, I like to pay attention to how much it's changed on a weekly basis, and then I also do a 4-week average of those changes. Now, everything in trading is relative, so when it's a nice big booming market, I'll look for a 4% move up or a 4% move down to trigger a buy or sell signal. It gives me an indication that, all stocks are doing really well. This is a stock index that contains a little bit over 1,600 stocks of companies from the NYSE, the American Stock Exchange, the NASDAQ, and the over-the-counter market. I prefer the value line arithmetic composite index because all stocks are weighted equally. It's as if your portfolio held equal amounts of each stock. I feel like it gives me a quick and more accurate overview of how all stocks are behaving as opposed to a weighted index. I get this information from Bar Chart. Here's the web page if you're curious. You can find a lot of great information at this website. I also create my own charts. This one is one from online that I copied just to give me some comparison reference, but this is actually made up right on my chart. You can see the blue line here, gathering all the data. It's the closes, just like to keep track of that. The next page is an index summary that I like to use. Here are some of the things that I like to track. I get my data from MarketSmith. It's a sister company from Investor's Business Daily. I like to track the indexes, and I like to see how far off new highs they are. Also, I like to keep track of the 5-day change, the year-to-date change, and the 52-week change for the various indices: NASDAQ, S&P, mid-cap, small-cap, Russell 2000, NYSE, and then a few IBD things. I also keep track of the volatility and gold. As a growth investor, it's very important to me to know where the leadership is and to see how small caps are performing. I then take this material and I have charts. You can see when I click onto the graph what it covers. For me, if I can't see change, I can't trade change. And so I try to structure the data that I have in ways that help me see what's going on. And that's one of the reasons I love charts. It gives me a quick overview at where things are. You know, here you can see it's into new highs. But also, if you look at the data on the chart, you can see it's kind of been stuck in a range, and when it goes beyond this range, it'll snap back and head towards the mean. Then I take a quick look at the sectors. This is very much a top-down approach. This is just information that I get from my broker that I copy and paste into my spreadsheet. I like to look at the 1-month, 3-month, and 6-month change for the 10 sectors: materials, utilities, energies. You can see just track it all: 3-month, 6-month. I like to have a broader view, a bigger view. I like to look at the forest first and then look at some of the trees. The thing that I kind of like about this particular structure is it's almost like a chart in and of itself. I can easily see when a when a sector is advancing, and I can track it more easily with the eye than I could just by looking at raw data numbers. From here we move on to ETF sectors. What I've done is I've selected some of the ETFs for various sectors that I think are important to me. I try to focus in on ones with larger liquidity whenever possible, but certain ones, you don't have that option. And once a week I log the weekly change and the monthly change, and I keep track of it. Then I do a tally, as I often do. My main thing is I want to try to make data actionable and make it so that I can see what's going on. When you have a lot of material, sometimes it's hard to distinguish what's really happening. So in this tally highlight, you can see the blue box that surrounds the data. I like to do a little 4-week look back, and it's very simple. It just gives me a quick and easy way to see where the leadership has been over the last 4 weeks in the ETF sectors. It's nothing fancy. 2 things I really like to use in order to see change is acceleration and deceleration. So here are the same ETF sectors, then I just break down their weekly change compared from week to week to week. Have a quick program or formula here that will tell me if there's acceleration. You can see when I click into the cell what the formula is, and the boxes are highlighted. And what I want to know is there acceleration for my longs? So I can see healthcare has been doing well. Maybe I would look at some healthcare stocks, try to capitalize on that. A lot of weeks down. A quick view just by looking at this, I can easily see that there's been more down weeks than up weeks. So that might give me a clue that the market sentiment and the market conditions are changing. I do the same thing for the monthly data. It's absolutely identical in every way. You'll see the different colors: the yellow, the red, the green. Those are giving me the market conditions as per IBD's market outlook or market pulse. I like to know how stocks are performing in relationship to how the market's doing. The next one I do is I also keep track of the relative strength week to week for these various ETF sectors that I like to monitor. Very simple formulas to determine whether there's acceleration or deceleration. It can give me a sense of where market leadership is and how the general market is behaving. The next thing that I do is probably the most time consuming of all of them, and really the more I've done it, the quicker I get at it. What I do is I go through the IBD paper and the research tables and sector leaders section. First I go in and I find out who all the sector leaders are for that week, and I put them in. And each sector leader has an industry group rank. That's the number you see after it. So I list all the numbers next to the ticker. Then I go through the paper. IBD has 33 sectors, and they're labeled from 1 to 33, 1 being the strongest, 33 being the weakest or the lagging sectors. And I go through the paper and I find out what rank they are, and I put them in order. You can see we have numbers 1 all the way up here through 33. So I arrange them in the sequence at which they appear in the paper, and then also I extract from the paper the percent change data for the week, or excuse me, year to date. So this is the year to date change. So you have the sector, the year to date change, and then the leaders within those sectors. And those leaders also have their industry group rank. I have them color coded so I can keep track of them. Blue, any ticker that's blue was new or just added this week. If it's red and it's been strike through, it's been removed from the leaders list. Green means that it's moved up week over week in its industry group rank. So LXFT, for example, this week its industry group rank is 70. Last week it was 72. So it's moving up, so I've color coded it green. Conversely, if it's moving down, I'll label it red. You can see a lot of these stocks in the medical sector have moved down or been eliminated altogether. And then black means it's unchanged. You know, if it had an industry group rank of 3 last week and 3 this week, well, nothing's happened, so it's going to be black. Over here in the corner, we have the total number of sector leaders. Now, you can get a lot of information just by looking at this. First of all, you can see over here just by looking at the number. That gives you a clue as to what condition the market's in. If you have a lot of sector leaders, then usually the market is behaving pretty well. The colored boxes around it, again, are the IBD market status. Yellow is under pressure, green is confirmed uptrend, red is market in correction. You can also tell what sectors are accelerating or decelerating. You can track how much they're moving up or moving back. Like business services, you can follow it with your eye. In fact, what I do with this data after I get it all punched in and all organized is I make a visual map. I use Snippet and Paint. I copy and paste the spreadsheet onto it, and then I mark it up and I track. As you can see right here, I'll track all the ones that are advancing into leadership, what's moving steady, and any big surges. It'd be something that moves up 3 or more sector ranks in a given week. Then I do the same for declining. And this way, I have a very easy, very simple, no-nonsense way of seeing what's moving, what's accelerating, what's decelerating. And that can give me clues as to where I might look for long candidates and short candidates. As most of you have heard me say many times, 3 out of 4 stocks will follow the general market, and 12% of a stock's move is attributed to the overall movement in a given sector, and 37% of a stock's movement is associated with the general movement of its industry group. I also like to take the sector progression information that I got from the 2 previous pages and just put them in a simple format, alphabetical. Here's the 33 sectors, and I just put the year-to-date change in a simple format where I can also monitor acceleration and deceleration in a different way, similar to all the other pages I've previously shown you. Again, in an attempt to see the data in a way that will help me trade it, I have made charts for all the 33 sectors, monitoring their weekly year-to-date changes. So you can see here they are. Another thing that I like to track when it comes to industry group is the weekly rank itself. This is similar to the others. Just have all the 197 industry groups that IBD uses and the sector rank that they're given each and every week. I use MarketSmith for this information. It's also listed in the paper, which would take conceivably a lot more time to enter. I make a note of whether it's accelerating or decelerating, and then I just have some general information I like to keep handy: year-to-date change, percent off high, market cap. Then I quickly move on to the industry group weekly relative strength. This is something I've been wanting to do for a long time, and I just recently started, which is why we don't have more of a rainbow spectrum here on the numbers, but it's structured exactly identical to the weekly rank. If I can see what industry groups have relative strength that's accelerating or decelerating, that can give me a tremendous edge and advantage on where to focus my search for stocks. Now these orange tabs down here also deal with the weekly industry groups. What they are is they're weekly new high summaries. I've taken the summary for the week from my daily spreadsheet, which I've already done a web lesson on, and I simply copy and paste that information into the spreadsheet. This would be last week, the prior week, and the prior week, telling me how many times. So for example, auto parts showed up 5 times in the top 20 for last week. And then I do a tally of all of these and say, well, for the last 6 weeks, medical managed care has been in the top 20 of the weekly summaries for the past 6 weeks. It just gives me a bigger picture view on what's moving and what's doing well in terms of industry groups. I do the exact same thing for percent of weekly highs. I do the same thing for relative strength as well. I like to keep track of those things. New highs, percent change, and relative strength. A final component I look at is the sentiment indicators, most of which are contrarian in nature. I like to track what stocks are doing better, big cap or small cap, value versus growth. I also like to look at the call-put ratio. And then in the paper you can also find the bull versus bears and the NYSE short interest ratio. They're all very helpful. And what I'm looking for is I'm looking for extremes, as with most sentiment indicators. Other good sentiment indicators to watch are the volatility index and the ratio of price premiums and calls versus puts. I use data from a fear and greed index online, tracking where the fear is at now and where it was a week ago, a month ago, and a year ago. All these can be found on the web really easily. And I also have the links on my business website. I'm going to show you really quickly in the paper where you can find these things. So here, usually in section A, mixed in with something not very important, you'll find the small cap versus big cap. Here's the numbers, and then when it tells you right here on the chart when the line's heading up, small caps are outperforming. Then you also have mutual funds versus growth funds. In a nice big bull market, you're going to see small caps outperforming big caps, and also you'll often see growth stocks outperforming value stocks. The next place you can find information is what's the market trend. There's a lot of great information on this page, but here you find the put versus calls trading volume, and I take the data directly from here. What's nice is they also give you this little visual chart. Then we move on to, usually in one of the unmarked pages, in the B section, you'll see the remaining information that I extract from the paper for this spreadsheet. You've got your bulls versus bears, your NYSE short interest. You have these wonderful handy charts that you can use to help you see the change. And then up here in the psychological market indicators, I use the volatility and the put versus calls. They've got other helpful things here, but those are predominantly what I focus on. Here is where I get the greed and fear. It's CNN Money, and it's a great little tool. They combine a bunch of different things into one to create this fear and greed indicator. And if you scroll down, you can click on to the various ways that it's judging whether there's extreme greed or neutral or fear. It gives you a little data, gives you a little graph. It's really quite nice. It's handy, it's simple, it's quick. Then there's some other miscellaneous data that I throw in there and I get from various sources. Freestockcharts.com is a great resource. So here I'm monitoring the S&P daily, weekly, 60-minute. I also like to, look at the NYSE and then the ETFs that correspond to them to give me a quick view of the market performance. Something that's really handy is when you look at charts that compare, ratio charts, the Russell versus the growth stocks versus the value. To see that in chart form, it's really nice. And of course I pay close attention to the Russell. You can also quickly look at how the various sectors are doing at stockcharts.com. And the point I want to make here is that the idea is to look at information in different ways and to find a way that works for you, that can help you see what you need to see to trade effectively. Here's chart, but then also you have these bar graphs. It can be very handy too. I like to pay attention to moving averages. I like to look at the number of stocks that are above their 50-day moving average, or the percent of S&P stocks that are above their moving average. One thing that has been really helpful is I'm able with XLQ to sort my universe, and I can quickly see which stocks are above the 200, how many are below it, how many are above the 50 or below the 50. And that, just something that simple, can give you a quick insight into how the market's behaving and what kind of market conditions you're dealing with. And that can apply to whatever stock universe you choose. It's also helpful to keep track of the advanced decline line. Stockcharts.com has some really great charts that are free, and then of course they have subscription service where they offer more. But here you have the new high, new lows, advanced decline. You can do it for the NASDAQ, the NYSE, all the different indexes. You can also find charts for the other miscellaneous sentiment indicators. Here's the options call versus puts, and you can look at the dollar index and things like that if you want to get more involved. So that's basically the weekend routine that I do. I start with a big picture view, and it's a top down. I use that information to help me locate stocks for long and short candidates, get a sense of the general market conditions and what strategies may or may not work. I'm not afraid to add new pages, and I'm not afraid to get rid of old pages or experiment with new ideas. It's important to be open to what you see and what you learn, and as you grow and change, your spreadsheets are going to grow and change, hopefully. Hopefully they'll get better, they'll become more efficient and more effective. Also, another suggestion is to try to automate wherever you can possibly automate. Punching data in by hand can be a slow and time-consuming process. And I can't stress how important it is that you have a routine, but it has to be a routine you'll do every day. And so if you have a spreadsheet or a routine that feels overwhelming, chances are you're not going to do it. And in order to be successful, you need to be consistent. Lastly, please keep in mind, I'm just one trader sharing what I do that works for me. You know, it may not work for you. Really, only you're responsible for your trading results. And if you're not getting the results that you want to achieve, then you need to keep learning, trying new things, and do the best you can to look at things from a different perspective. You need to find what works for you that fits your personality and your psychology. Thanks for watching.